inheritance tax and trusts. Now, the two, you could say, are quite closely linked. Why? Because you could say trusts are quite commonly used for inheritance tax planning purposes. Okay, so they're used for estate planning, but also inheritance tax planning quite specifically. Traditionally, trusts were the go-to for inheritance tax planning, but since the introduction of new rules, the benefits have slightly decreased, although they are still widely used by most families. Before we go on, don't forget to like, comment with your thoughts, share and subscribe to our channel. This video is brought to you by ASWATAX, Chartered Tax Advisors regulated by the Chartered Institute of Taxation. My name is Omar Aswat. Now, I must say, when it comes to inheritance tax and trusts, quite specifically, the tax laws are extremely complex and technical. And of course, the aim of these videos is not to bore you with that stuff, as in that's for us to look at, and that is what we look at for our clients. And as mentioned, trusts are used as part of inheritance tax planning. There are other mechanisms that can be used, such as family investment companies, gifting of assets, and there are many explorations that can be looked at when it comes to inheritance tax planning. And it's not a one-size-fits-all. So each client or each individual, each family's circumstances needs to be looked at broadly. And then based on that, we provide bespoke solutions. I will explain or outline the three common inheritance tax issues that are related to trust. And the first is in relation to the set law. So as mentioned, the set law is the one who introduces assets into the trust for the benefit of the beneficiaries. And if the set law introduces more than £325,000, which is the current nil rate band, if it's available, that needs to be looked at first, but let's just say it is available. If the individual, the set law, if he or her introduces more than £325,000 into the trust in lifetime, then any excess would be subject to inheritance tax. So that's one of the reasons it's not the most ideal structure, especially if someone has, if an individual wants to introduce, let's just say, £1 million. Now, the excess of 325,000, which is about 675,000, will immediately be subject to 20% lifetime tax. So it's not ideal, and that's where a family investment company may potentially be explored, whereby there are no initial introducer tax charges, you could call them. The second implication, where inheritance tax is closely related to trusts, is that all trusts are subject to a 10-year charge, otherwise known as a principal charge or a periodic charge. So 10-year charge, principal charge, periodic charge. I think there's another charge as well, another name, but these are all just terminology, all meaning the same thing, which is that the trust on each 10th anniversary since creation is subject to 6% on the value of the assets held within the trust the day before the 10th anniversary. So obviously a valuation exercise needs to take place to value the assets held within the trust, and then the 6% charge is then applied on values exceeding £325,000. Again, this is, you could see as some sort of negative of trust. However, at times the 6% is a small hit compared to the 40% death tax that is payable if the assets were held by the individual that died. So for example, if the individual that died owned assets of £1 million and in a personal capacity, and he or she died, then there's 40% death tax due potentially. But if the assets are transferred into trust for some sort of planning, for IHT planning purposes, then yes, one may argue that, oh, the trust needs to pay 6% after 10 years. But you'd rather at times pay 6% than the 40%. That again, bespoke, we offer a bespoke service. We need to look at all the angles and see exactly what works for you and the family. I must just comment though that many opportunities can be explored that can mitigate and potentially at times eliminate IHT. And it's just sad to see that every year the IHT receipts by the government is just increasing by 10% per annum. So more and more people are paying inheritance tax, which is a bit of a shame, because there are planning techniques that can quite cleverly and within the spirit of the law, as in HMRC have approved all these schemes, be introduced into a family sort of planning. Because if you think about it, on death, without planning, on each individual's death, 40% of the family wealth, the generational wealth, is being lost to the taxman. So yeah, a bit off topic there, but the 10-year charge is a charge on the trust assets on each 10th anniversary, so 6%. And the third common IHT implication that arises when it comes to a trust, and the third common type of IHT implication that arises when it comes to trust, is the exit charge. And that is a charge on the value of assets leaving a trust. Okay, so assets leave the trust. On that value, again, there's potentially up to 6% tax payable. But again, the 10-year charge, the exit charge are very complex calculations. They need to be looked at expertly, and obviously the correct disclosure must be made on the trust returns and the relevant IHT forms as well, which we can assist with. Just to make a comment, you would have seen in the income tax and capital gains tax video in relation to trust that obviously when assets exit the trust, there's potential capital gains tax that needs to be looked at on the trust. But specifically speaking, IHT is payable, and therefore there is some sort of relief that can potentially be explored to eliminate or defer the CGT charge. I hope that was beneficial. I hope that was useful. So we went through 3 topics. We went through the set law introducing assets over £325,000 or over the available nil rate band, which gives rise to some sort of IHT lifetime tax at 20% usually. The 10-year charge or principal charge, 6% on each 10th anniversary, and exit charge, which are assets leaving the trust, IHT is payable. As mentioned, trusts are still extremely popular and highly useful vehicles for inheritance tax planning purposes. Do get in touch. My email address is above, omar@aswtax.co.uk. We are chartered tax advisors. I am too, and I will be happy to assist in your individual and family circumstances. Thank you for watching. Thank you for listening. Don't forget to like, comment, share and subscribe. See you soon. Thank you. Bye.